Many of you asked me to do yet another video on CVS. Most of you are sick of this company. This might actually be the last video because I did like 6-7 videos on this company, but I'm gonna review their earnings report and try to update you on what I think of the report and update you on CVS in general. And the report did have a lot of positive things, but I have to admit there was a lot of things that I actually did not like in the latest earnings call and the earnings report. I'm gonna share them in this video. It might upset some of you that really like CVS, but I think most of you follow my channel for me not to tell you whatever makes you feel better or whatever sounds best. I just always try to look at the data and try to say the truth on what I actually believe. And if the facts change with any of the investments that I own or the thesis changes, then I have to change my mind with the company. And there's a lot of things that kind of changed with CVS that I'm actually going to talk about in this video. Now, if we look at the earnings report, it was actually not bad at all. I mean, EPS, they did beat 221 versus 211. Pretty good. Revenue, they beat also on revenue by around 3 billion, which is great. They also announced some job cuts, around 5,000 jobs that are going to be cut, mostly corporate, kind of jobs, because now they are integrating Oak Street Health and Signify Health, which would, give them much more employees, and they're just reducing them, which is going to help save costs and increase the margins for CVS. And I did look at the report. I mean, you could look at it. It's pretty easy to look at. I mean, they did, grow 10.3% revenue. It wasn't really bad at all. But there was some things that I did not like with CVS. One of the things I didn't like was the guidance. If you remember, I showed you this picture many times, and I said that CVS is expecting, to make $9 of EPS in 2024 and $10 of EPS in 2025. And I did show you where CVS was trading at in terms of a PE ratio, that it's now sitting around 8.5 times earnings. Actually, when I talked about it, it was around 7.5 times. It has rallied around 10% or 11% since my last video. So most of you are actually up on CVS if you ever bought it. But I did show you those two things. And I said, in my opinion, this is a massive overreaction from the market because of the uncertainty around the Oak Street Health and the Signify Health acquisition. It's the same thing that happened with Aetna. And eventually CVS is going to return to 10 or 11 times earnings where it was trading at not actually too long ago. And if CVS returns to 10 times earnings and CVS does reach the $10 EPS in 2025, this is $100 per share, or over 30 or 35% on the upside over the next 2 to 3 years, plus a dividend, which is an amazing return. This was my thesis, but this has actually changed after the earnings call. And in the earnings call, CVS's CFO now expects the 2024 EPS per share to be between $8.50 to $8.75, which is flat from 2023. They're no longer expecting the $9 EPS. They're expecting flat EPS between 2023 and 2024, so pretty much no growth. And the $10 in 2025 that we based our thesis on should also be cut. Now, we don't know what it's going to be. It could be $8.75, it could be $9, it could be a decline, maybe, from 2023 to 2025, which would mess up the entire thesis that we talked about here on YouTube. And this is not me trying to change my mind or trying to do anything, but this is just a fact of what's happening. The company gave a very optimistic guidance. They couldn't reach it, so they pretty much cut it out. And it was the right thing to do because there's nothing worse than missing on your own guidance. Now they lowered the ball and they can, it's going to be easier for them to actually beat in the future. So it's not too bad, but it pretty much messed up all the videos that I did on the $10 EPS trading at 10 times earnings. That could be 30 to 35% on the upside, excluding the dividend, which is 3% over the next, pretty much 2 to 3 years, which would be an amazing return. This has actually changed. And I'm going to update you actually on my upside potential for CVS. But if we look at the balance sheet right now, a lot of things have changed too. Now they have pretty close to $14 billion in cash, and they have $3 billion in investments, which is around $17 billion in total. Now their long-term debt, we can have a clearer picture after Oak Street and Signify. They have over $61.5 billion of long-term debt, which is pretty much 11 billion more than what they had last year. Because of those two acquisitions, the net debt would be around 43 or 44 billion after you take out the cash and the investments. I did many videos on it. You could watch my previous videos. I still believe the debt is manageable within CVS because they have over $7 billion of extra free cash flow after they do the dividend every single year for them to actually start paying down the debt. So I don't believe the debt is a big problem. I still believe it's not a big problem. But the main thing that has changed with me is actually their own guidance, as they have no confidence in it and it's going to be flat for 2024. And we don't know what it's going to be in 2025. So the way I'm thinking about CVS right now, I'm thinking of $9 of EPS that was in 2024. It might actually be in 2025, meaning they reach it, around 2025. Now, in this case, if the $9 of EPS was reached in 2025 and CVS does trade at 10 times earnings, which I believe is very, very fair for the company, and it trades, at $90 per share, and you could divide it by the current price, which is around $74 per share, this would be around 21% on the upside, and you have a 3% dividend, which is 6% over the next 2 years or 2.5 years. In total, that would be around 27% on the upside over the next 2 to 3 years, which is actually not a bad return at all, but it's much lower than what I was expecting of around 35 to 40% over the next 2 to 3 years. I have no confidence in this whatsoever, not like what I did before, because CVS did lower the guidance. So now I'm personally expecting my fair value for CVS to be $90 per share, or around 27% on the upside over the next 2 to 3 years, which is actually not a bad return at all. So there's still a massive margin of safety, especially if you're a dividend investor. CVS has a pretty good dividend that they grow around 3%. So there's nothing wrong with the company. It's not bad at all. But my fair value has been lowered from $100 per share to $90 per share, which would lower the upside to around 25 to 27%. And in this case, if you're a more open-minded investor and you're not kind of attached to CVS, you could actually find maybe better opportunities in the market with similar upside and much lower debt if you're trying to look into those things. I share a lot of them in my own investment group, but I still believe CVS is undervalued. The only thing that changed is my fair value and my upside potential, which is much lower than what it was before. And CVS could potentially face some problems in the future because the Justice Department, they're starting some kind of a monopoly investigation into United Healthcare and CVS. And this is not a sure thing. Maybe it could just rumors. I haven't read the entire article, but it's on Seeking Alpha, and I believe this is what's actually happening. But normally such things take time to play out, so it might not happen before maybe 2, 3, or even 4 years before something happens, or maybe they want to break CVS or something, which in this case, CVS would be worth much more and United Healthcare than what they are worth right now. So I'm still bullish on CVS. I still believe CVS is undervalued. It's an amazing company, but I don't have the confidence I had before because the management themselves, they don't have the confidence that they had before whenever they issued this guidance. I believe they did the right thing in lowering the guidance, but now I have to lower my fair value for CVS from $100 per share to $90 per share, which would be 25 to 27% on the upside over the next 2 to 3 years, including dividend, which is actually not bad at all. This was no financial advice, of course. I hope you enjoyed this video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.